All right, Zoom video. Those earnings are out. Pretty much a beat across the board as expected. 4Q revenue coming in at 882 million. The estimate was for 811. But when you look at it on a year-over-year basis, that's a 369% jump in revenue. Similar story with regards to their EPS numbers. As far as their forecast, that growth is going to moderate, looking for about 153% growth in revenue for its fiscal Q1. That number is 900 to 905. That's the range they're giving there. The street estimate there, Taylor and Caroline, was for 829.
Let's get into it with Amine Bensaid of Bloomberg Intelligence. And I mean, it's pretty incredible to think about such high performance of the stock, such high expectations, and yet it seems like they've managed to even beat those.
Absolutely. And also, as Romain mentioned, when you look at the growth outlook and their guidance for not only the first quarter, but this year, it's almost double consensus, around 40%. And yes, 40% is a significant drop from 300% that happened in an unusual year. But I think consensus was looking at a much lower number and a higher moderation. So I think that's going to be the key focus here for these companies, explain how they can and what they can do to maintain a churn and have a significant revenue growth even post-pandemic.
Post-pandemic, the competition is probably going to be people going back into their office rather than the rivals that are out there. But talk to us about how it competes with the Google Meet or indeed the Teams coming from Microsoft. Are people continuing to remain latched on to Zoom?
That's a very good question. So I think it's divided in two ways. It's the large customers, the enterprise customers, which is the focus what Zoom is trying to achieve. They have, a better chance of getting higher penetration there, and that's by doing, like Romain mentioned earlier, probably some M&A. But the other side, like schools, I think the churn is probably going to be higher on that level. So it's really just what the company decides to do to pursue that growth, either building their own product, especially in the collaboration space versus the Microsofts of the world, or, doing more M&A to quickly capture that growth rate.
I am curious. So when we talk about, look, a company like this doesn't need necessarily to continue growing at 100+% or whatever it's forecasting now going into Q1. At some point, the moderation has to come in there. What do you think is going to satisfy investors there? Do you think that they will be satisfied with, say, a 30% growth rate as long as they're getting some type of maybe margin expansion? What's next for investors to look for beyond just revenue growth?
That's a very good question. I think that's going to be the focus in today's earnings call, which is what are the plans that the company is going to pursue to not maintain the growth, because I don't think anyone is expecting them to maintain the 300% or 200% growth rate, but what other plans that they're trying to do to better position themselves basically post-pandemic. So like I mentioned, I think maybe M&A could be a logical way to either improve their exposure in the collaboration space or the content center space, as it's been rumored. Otherwise, I think, just having plans, either just building up their own product, but that I think it's going to take longer to achieve.